Events after the reporting period. Adjust or just disclose. Hello, and welcome to Candymentor. In this lesson, we'll unpack IND AS 10, the rulebook for events that happen after your balance sheet date, but before the financial statements are approved. You'll learn how to spot adjusting events, how to treat non-adjusting events, and when a disclosure is enough versus when an adjustment is required. Objective of IND AS 10. The standard's job is straightforward. Make financial statements reflect relevant events up to approval. It ensures users see the period-end position with important later information included. But it also prevents abuse. You cannot change year-end results using post-year facts unless they prove an existing condition. In short, be relevant, be fair, and don't rewrite the past with future facts. The meaning of events after reporting period. These are events that occur between two dates: the reporting date, your balance sheet date, and the date of approval, when the board signs off the financials. Events can be good or bad. Key idea: only events that relate to conditions existing at the reporting date can change the numbers. If the condition arose after the reporting date, you usually disclose only. Classification of events. IND AS 10 divides events into two clear buckets. A. Adjusting events. They provide evidence about conditions that existed on the balance sheet date. B. Non-adjusting events. They show conditions that arose after that date. This binary test drives every treatment decision. Adjusting events. Definition and logic. An adjusting event gives further evidence about an existing situation at year-end. When that happens, you must update the financial statements. Why? Because the event reveals the true state of affairs at the reporting date. Think, the condition existed then. You only learned more afterwards. Examples of adjusting events. Practical examples make this stick. You settle a supplier claim after year-end, and settlement confirms the liability existed on the reporting date. New information arrives, showing an asset was impaired at year-end. A customer declared bankrupt shortly after year-end, but signs of insolvency existed earlier. You discover fraud or an error that existed before year-end. A court case settles and proves an obligation existed at the balance sheet date. In each case, adjust the numbers in the financials. Non-adjusting events. Definition and logic. Non-adjusting events point to new conditions that arose after the reporting date. You do not change the financial statement numbers for these events. However, if they are material, you must disclose them. The disclosure helps users understand potential future effects on the business. Then, examples of non-adjusting events. Common non-adjusting events include a major fall in market value of investments after year-end, a fire or flood that happened after the reporting date, announcements of restructuring or acquisitions after year-end, issue of shares or debentures after the reporting date, abnormal post-year declines in asset prices. These need disclosure if they matter to users. Determining adjust versus non-adjust. Key test. Use one practical question. Did the condition exist on or before the reporting date? If yes, adjust the financials. If no, disclose. Don't adjust. Example check. A customer goes bankrupt on April 10th. If signs of insolvency existed on March 31st, adjust. If not, disclose only. End. Dividends declared after reporting date. Dividends proposed or declared after the reporting date are non-adjusting. You do not record a liability at year-end for those dividends. However, if dividends are approved before financial statement approval, disclose them in the notes. Record the dividend liability only when it's formally approved as per corporate law. Going concern considerations. Some post-year events may cast doubt on going concern. If so, the whole accounting basis may change. Example, a major customer bankruptcy that threatens survival. If the entity cannot continue, prepare statements on a liquidation basis, not going concern. Always reassess going concern before approval. Date of authorization for issue. The authorization date is critical. It sets the cutoff for events covered by IND AS 10. Example, reporting date 31st March and board approval on 20th May. Events from 1st April to 20th May fall under IND AS 10. Document the approval date carefully. It determines what you must review. Responsibilities of management. Management must identify and evaluate all events in the post-year window. Assess materiality and decide. Adjust, disclose, or ignore. Document your reasoning for auditors and regulators. Coordinate closely with auditors during the subsequent events review. Good documentation makes audit queries simple to resolve. Financial statement adjustments. When an event is adjusting, change the relevant figures directly. Update related disclosures as well. Provisions, impairments, asset recoverability. If necessary, adjust comparative figures to maintain consistency. Check IND AS 8 for links to prior period errors and estimate changes. Disclosure requirements for non-adjusting events. For material non-adjusting events, disclose the nature of the event and an estimate of financial effect, or say you cannot estimate it. Examples: fire destroying a plant after year end. Disclose estimated loss. Major acquisitions announced after the reporting date. Disclose nature and possible impact. Transparency is the goal. Illustrative adjusting event scenario. Reporting date March 31st. Customer XYZ owed 20 lakh rupees. On April 15th, XYZ declared bankruptcy due to long-standing issues. Because the problem existed before March 31st, adjust receivables down. Record the impairment in the March 31st financials. Illustrative non-adjusting event scenario. Reporting date March 31st. On April 10th, a fire destroyed a factory. Cause after year-end. Do not adjust March 31 numbers, but disclose the event and estimate of impact in the notes. This keeps users informed without altering historical figures. Impact on audit and reporting. Auditors perform a subsequent events review until the report date. They test management's identification and classification of events. Adjusting events must be reflected before sign-off. Material non-adjusting events require disclosure or an emphasis of matter paragraph. Close coordination reduces last-minute audit findings. Interaction with other standards. IND AS 10 links to several standards. IND AS 1 for presentation and disclosure. IND AS 37 for provisions tied to adjusting events. IND AS 8 if an event reveals a prior period error. Use these cross-references to ensure consistent treatment. Amend. Common mistakes and audit focus. Watch out for these pitfalls. Treating all post-year losses as adjusting. Ignoring going concern implications. Failing to document management's assessment. Recording dividends as liabilities prematurely. Omitting disclosure of significant non-adjusting events. Fix these and audits will be smoother. Practical checklist. Before you finalize the statements, do this checklist. Identify all events from year-end to approval date. Classify each as adjusting or non-adjusting. Assess materiality and estimate financial effects. Update financials for adjusting events. Prepare clear disclosure notes for non-adjusting events. Reassess going concern assumption. Simple, systematic, defensible. Awkwardly. Summarize. Ending. Disclosure format example. Note X. Events after the reporting period. On 12 April 2025, a fire occurred at the company's warehouse, resulting in estimated loss of 5 crore. The event occurred after the reporting date and does not relate to conditions existing at 31 March 2025. Accordingly, no adjustments have been made in these financial statements. Use plain language, state the dates, give estimates where possible. Summary table. Adjust or disclose. Event type, example, treatment. All this information will be published on the following day and all this information will be published, except for the account's description. This information will be published, except for the account's description. This information will be published. Link with going concern reassessment. Even a non-adjusting event can force a going concern rethink. If post-year news shows the company cannot continue, change the accounting basis. Example, a regulatory ban announced after year-end that halts operations. Disclose and, if required, prepare statements on a liquidation basis. Omnis. Numerical illustration scenario A, adjusting. Provision for legal case 5 lakh at year-end. On April 10th, court orders 8 lakh for that same case. Adjust provision to 8 lakh before approval. Scenario B, non-adjusting. A new case filed on April 5th for a post-year incident. Do not adjust year-end numbers. Disclose the new case and estimated exposure. Closing summary. IND AS 10 is the guardrail between 2 reporting periods. Ask one question for every event. Did the condition exist at the balance sheet date? If yes, adjust. If no, disclose if material. Always document your judgment and reassess going concern. Do this and your financials will be honest, useful, and audit-ready. Final takeaway. IND AS 10 helps you respect the past while being transparent about the future. Adjust only when justified. Disclose always when material, and keep the user's ability to make decisions front and center.